Recessions are the cure for the malinvestment. They're called corrections for a reason. It gets us back to where we're supposed to be.
What's going on, everybody? I'm your host, Chris Naugle, and welcome back to the show. Today, we have an amazing episode. We are going to unravel the economic machine. I don't have Ray Dalio on, but I got Joe Brown from Heresy Financial, and we are literally going to unpack this thing in a way that you need to hear, because if you don't pay attention to what's going on, if you don't see the signs of what's going on, you are not going to have a fun time in the years to come. Joe is an expert in this. You got to check out his YouTube, which we're going to put in the description, and you got to listen to this because this is your last stop to financial freedom and also financial preservation. Joe, welcome to the show.
Hey, thank you so much for having me on. Excited to be here.
Absolutely. So, I got to get right into it. We talked a little offline about Heresy Financial. How'd you come up with that name? I think it's just a fascinating story.
Yeah. So I'll tell you what the word means, and I'll tell you how I came across it. So the word heresy, it's an old religious term for anybody who isn't familiar with it. And Galileo is an early example of this, where he said, "Hey, the Earth goes around the sun. It's not the other way around." And he was labeled a heretic. He was kicked out of the church for that. And turns out, well, he was right. And many times throughout history, when you have somebody, another good example, I don't remember his name. He was a doctor and he was trying to figure out why so many women were dying in childbirth. And he came up with the idea that there were germs and there's bacteria and that doctors need to wash their hands, because the doctors were going and they were operating on these ladies who had died in childbirth. And then immediately they'd go turn around and they'd deliver a baby. And then that lady would die in childbirth. And he was like, you know what? There's probably something on your hands that you're spreading to these healthy mothers and you're infecting them and it's killing them. And this medical establishment couldn't handle that with the arrogance, and they said, no, you're wrong, and we're kicking you out of the medical industry. This guy ended up committing suicide, and it turns out years later they found out, oh, he was actually right. We do have germs that can be spread, and we need to wash our hands. And so more often than not, when somebody comes around and tells the truth about the way things really are against a mainstream narrative, they're labeled a heretic, labeled dangerous, labeled misinformation, and many times it ends up being proven correct. And so I was a stockbroker for about 5 years. Throughout that time, I started researching and trying to learn how the economic machine actually works. And I ended up finding out that it's very different than what the mainstream beliefs are. And therefore, what you need to do to succeed financially is very different than what the mainstream says you should do. And so I've always kind of felt like a little bit of a heretic, financially speaking. And so that's the origin of the name Heresy Financial.
Oh, gosh, I love it. And that is so true. You listen to those stories, folks, and you then kind of go into the future and you're like, wow, they were right. But back then they were just ridiculed and put down, and in some cases put down so bad that that doctor committed suicide, and all along he was right. And whether it's Joe or me or either one of our YouTube channels, a lot of what we're saying and a lot of what you're going to hear in this podcast is going to tell you exactly that. Stuff that other people are going to tell you is not true, is not the case, is not going to happen. And in the future, we're going to see that it probably will. Which is why early on I said, you really need to listen to this, because right now we're at a very pivotal time. And that's the first question I have for you, Joe, is, given all your research and studying, and you come from the Wall Street world, so clearly you understand the cracks in the foundation on that level. And now you translate it to a more macro view, or just a more holistic view of the economic machine, as you called it. Where are we right now in the economic cycle, and where do you think we're going in the next 2 to 5 years?
Yeah, good question. Okay, so we've got two approaches to that. We've got the short term and we've got the long term. When I say long term, I'm looking at 40 years up, 40 years down type of a cycle. Short term, looking at 2 to 3 years. So which one should we go into first?
Let's do most people are short term thinkers, so let's just go short term. Let's go 2 to 3 years.
All right. So let's go back about 3 years to the start of 2020 when all the money printing happened. At that point, they expanded the money supply by roughly 40% when all was said and done. The Federal Reserve is the one that does that. So they expand the money supply, but the way that they do this is not exactly the way that people think. The Federal Reserve is not printing dollars and directly handing them out to people, giving them to the US government. The only way that they can inject new money into the economy is by buying things. And they're very limited in what they can buy. Basically, it's treasuries and mortgage-backed securities. And so for the most part, a lot of this money that they printed, they used to buy treasuries. So what is a treasury? A treasury is debt from the United States government. So the government borrows money. Most of the money that the Federal Reserve printed made its way there. It's important to understand, for reasons we'll realize later, that this is not a direct process. So the government cannot borrow money directly from the Federal Reserve. They can only borrow it from other places on the open market, usually banks. And so the Federal Reserve, in order to print money and get it into the hands of the US government, has to use banks as middlemen. So here's how that works. Government borrows money from a bank, and in so doing creates this contract called a bond or a treasury. It's debt. The bank then says, well, I don't want the government to owe me money, so does anybody want to buy this debt from me? The Federal Reserve comes along and says, yes, we'll buy that debt from you. So the Federal Reserve prints dollars, buys the debt from the bank. So the bank gets cash, the Federal Reserve gets the debt. Now the government owes that money to the Federal Reserve instead of to the bank. Well, the bank now has fresh cash. So what do? They turn around and loan it to the US government again. So they just continue to repeat this process. Banks are the middlemen between money printing and government borrowing. So in the end, the government owes a lot of extra money to the Federal Reserve that was printed out of thin air. The government then has to turn around and they do something with that. And starting in 2020, they started spending it on all sorts of crazy stuff. A lot of stimulus checks, PPP loans, just paychecks to different organizations. Congress got a little raise. So there's all sorts of things that the government started spending extra money on. When that money gets spent, it works its way throughout the economy. So every time a dollar gets spent, it goes from one person's bank account to another. So it starts in the government's bank account, then it goes into the bank account of a Social Security recipient, or the bank account of a military contractor, or the bank account of a politician. And then whoever receives that deposit then goes out and at some point spends that money. And maybe they spend that money on supplies, like from a manufacturer, or they spend that money at a grocery store. And then that dollar goes from their bank account to another person's bank account. And it just cycles through the system. As that money cycles through bank account to bank account, it's being used to purchase things, which bids up the prices. Imagine like on eBay, an auction process. If more people come in to bid on things, then like an auction, it's going to push the prices up. And that's what happens when the government starts spending that money they borrowed into the economy. It bids prices up. Historically, the increase in the money supply had never been so great. There's an unprecedented spike in the money supply. For some reason, they didn't anticipate that this would cause inflation. If you want to give them the benefit of the doubt, maybe they just thought that was the right amount of money to offset the crash that would have happened without the money printing. But it definitely did set in, and it caused a massive amount of inflation. Once the Federal Reserve realized this, you could see they kind of changed their tune pretty quickly. And they realized, hey, if we keep interest rates low and people continue to borrow, the government continues to borrow, we keep on expanding the money supply like this, it's very easy. It would be very easy to have hyperinflation. People start spending money more rapidly, the dollar starts losing value very rapidly, and it's game over for the United States as the global reigning superpower. So they said, look, we need to get ahead of this. So they said, we're going to raise rates. And they did. They said, we're going to reduce our balance sheet, which instead of printing money to buy things, to make loans, they did the opposite. They let those loans get paid back. So they've been doing this now ever since April of 2022. That's when the money supply in their balance sheet peaked. It's important to note the timing on this because when did inflation start after the money printing? Money printing took place in March of 2020. March of 2021 was when the inflation rate finally got back to where it was before 2020. And then after that, it skyrocketed to its all-time high. So it took a year before the inflation rate even got back to normal. April 2022 is when the money supply peaked. It's actually been declining since then. Every single month, it moves down. There's less money in the system now than there was in April of 2022. And so you ask, well, why hasn't deflation happened yet? The same answer. There's a lag to it. So it's been almost a year and a half since then, and we've seen the inflation rate come down from its all-time high to the most recent reading of 3%. I would argue that the most likely scenario moving forward is that those lag effects of the money supply decreasing are starting to catch up to us right now, and we're about to dip over into deflation. The money supply has been decreasing. Interest rates are high. The government is borrowing more than it did last year at way higher interest rates. So it's having to spend a lot more of its money just to pay the interest on its debt. We have student loan payments resuming in October. We have all of these things happening right at the same time. Looks like there's just not enough money in the system to continue to keep prices where they are. We're about to start experiencing deflation here very soon. So that's kind of the last 3 years catching us up to where we are right now, looking forward for the next couple of quarters.
And I think it's really easy to see that. For anybody out there living their life, doing whatever they're doing, you've seen the impacts of exactly what has just been explained by Joe. You've seen money get more expensive. You've seen the cost of goods go up. It's really not the cost of goods going up. It's just your dollars buy less. But from the surface, it just looks like everything's more expensive. You've also realized when you go to the bank to borrow money, it's not easy anymore. I don't care how much you make. I don't care what your credit score is. It is not easy getting a loan. Back prior, when all the printing was happening and we were peaking up, it was so easy to get a loan. You walk in before you even got your dum-dum sucker, they were handing you a check and shooting you back out the door, being like, hey, we'll see you next time. Now, all of a sudden, it's different. So this is all the effects that have happened. But, we're not the only ones, Joe, that have been through this. I believe Japan had a very similar situation happen. Oh, a little, what about, was that 20 years ago now? I'm losing track of time as I get older, but they never came out of it. They never, ever came out of that situation, and they did almost the exact same thing the United States is doing, but they didn't have the dollar. So you really got to look at it and say, how much strength does the dollar have? And and there's some people starting to question whether or not Keynesian economics and modern monetary theory economics are actually going to work. And can they literally play God and manipulate this whole thing and just keep this? I mean, there are economists out there saying, I cannot believe it hasn't crashed yet. But I can't remember, and Joe, maybe you do, but there was a famous person that once said the markets will continue a trend longer than you will have solvency, something to that extent. Yeah. You can't time the markets. Ray Dalio, of all people, almost went bankrupt, almost lost everything because he thought he knew something that was true, but it didn't happen because he tried to understand something that was literally out of his control. And I love your description of where we went month by month, year by year, and here we are. So what happens now?
Yeah. Well, I think there's a couple key distinctions. Number one, it's important to look at the similarities between what's happening now and seeing if you can identify any of those same patterns that have happened anywhere else in the world and throughout history. And that's one of the areas where I think reading books is very valuable, because historians have documented these major things happening throughout history for a long time. And the more you study these things, the more pattern recognition sets in. You say, okay, that looks similar to right now. That looks very different than it does right now. So you brought up Japan. Japan is a great example. There are some key differences between us and Japan right now. The main differences are they run twin surpluses and we run twin deficits. And so they run a trade surplus, meaning they sell more stuff to other countries than they buy from other countries. So they've got money coming in from that. They also run a budget surplus for the most part. The United States runs twin deficits, so the government spends more money than it takes in taxes, so it has to borrow to make up the difference. And the country overall, we buy more stuff from other countries than we sell. And so, as a result of that, it's called the net international investment position of the United States is very, very poor versus Japan. It's very strong. And so that difference has allowed Japan to maintain kind of this monetary policy that if we continue to the same extent that they did, will be much more harmful for us in terms of things like inflation. The third difference that I would say is meaningful, though it's hard to quantify, is the cultural difference. And so they've had a very easy monetary policy for a long time. Debt has been very cheap for a long time there. At the same time, though, both corporations and individuals have increased their savings rate and deleveraged over the past, 2 decades. So the central bank policy has been to try and increase the money supply, but the cultural actions have offset that through saving and paying off debt. And so the net increase in the total money supply in Japan has been nowhere near what it's been in the United States over the exact same time period. And that was even true pre-2020, pre-COVID. And so I would say that the strength of the dollar around the world as the global reserve currency is the only thing that has allowed us to hang on to this monetary policy for this long. And so basically, it's a position where you can, if you have the global reserve currency, you've got a large buffer. The world will absorb the abuse of your currency. But the more you use that and abuse it, the less the world will want to do that. And so at this point, that is where we are. And so we still have that buffer zone around the world, but it has been changing over the last decade, especially with like central bank holdings of treasuries around the world. Most central banks are selling treasuries now instead of buying them, which has never been the case before.
An interesting thing, Joe, and we study, the same exact things. And, I just saw reports the other day. There was 2 interesting reports that I'd like to bring up. One, Japan, I mean, it's no secret. They're the number one holder of United States debt, being treasury bonds. They're number one by a pretty large margin. A lot of people think China is, but China is not. And then the second thing I want to hit on is, I have a slight difference to Ray Dalio. Now, when I listen to Ray Dalio, I really read between the lines, especially when he was still working, with Bridgewater, as a CEO. His book Principles talks in the third and final section of that book about his final, push, his final goal in passion, which is teaching people and telling and warning people, which is what he's doing right now. But he also, I think, sometimes has to restrict what he's saying because he does manage his firm does manage China's money and the US's money. So when you hear him, he's very centric about US and China and this kind of, US going down, China coming up, and China could take over as the world power, which I'm not saying that's what I disagree with. I disagree because China has more problems right now than I think any other, emerging or almost developed country. And that is they have a huge demographic problem. Japan has the same demographic problem. We have a demographic problem, but it's not nearly as severe. So even if China were to become the dominant nation, if you will, the empire, how would they maintain that with their demographic problems? So I find some holes in what Ray Dalio says when he's talking about China. And also he talks about China having the leading reserve currency being the yuan. The yuan, I don't think in its current capacity could ever take over the dollar. I don't see how it could. Now, if the yuan got together with the BRICS, maybe just maybe if the Saudis came in with a major play, they could, but there's just no way any other currency right now could stand up to what the dollar has and what the dollar is in the dollar's use throughout the whole world. 60% of all transactions are the United States dollar. So I think a lot of people right now, when they listen to this stuff and they're just reading the news or listening to the news, they think that the US dollar is going to fold because of Fed now, the digital currency and this, but I don't see that could even happen inside, let's just say, the next decade.
Yeah. Great points, and there's two things there that I want to highlight. The first is the demographics problem, and then the second is the question of what could change a global reserve currency. And the answer to both of those is actually just policy decisions. So most people aren't aware, but the United States birth rate has been below replacement levels since the 70s. So if you look at how many babies are born by Americans, it is not enough to even replace our current population level since the 70s, for over 50 years. So the question is, well, how in the world has our population grown then? And the answer is immigration. Not to mention all the other benefits that immigrants bring to this country, like how many of them are, Fortune 500 CEOs and entrepreneurs and just brilliant people that have created a lot of wealth in this country. The demographics thing alone, we would have had a much smaller population today than we did in the 70s if we didn't have such an attractive place for people to come and live. People from all around the world want to come live here because of our freedom, our economic freedom, our rule of law. Everybody wants to come here because this is where you can come make money, where there's actually opportunity. That's a policy decision. And over the last, I don't want to put a number of years on it, but we've seen policies that have been, they look like they're trying to change the incentives in the system and making it more difficult for people to move here. Now, I'm not saying that China's doing the opposite, but I am saying that it's a policy decision. And if you recognize your country is going to collapse simply because of demographics, all you have to do is make your country more attractive than the other country for immigration, and people want to move to your country instead for the opportunity. Now, I'm not saying that's easy. I'm not saying that there's not momentum involved in that, or that it can happen overnight, but it is a policy decision. It's simply, hey, what are the rules that we have here? And is it more attractive or less attractive than the place next door? There are other places on earth where that's not the case, like in India and Africa. Their birth rates are fantastic, and they're growing very quickly, very young populations. And so, in terms of like places, international growth where I think, emerging markets are going to do really well, I would look at those two places over somewhere like China. But the demographics thing is real, and we just need to realize that it's, immigration has been the answer for the United States for many, many decades, and anybody else could do that too. The second thing is the currency issue, which is how does the dollar ever get replaced? Ray Dalio has in his book, actually he has this in both of his books, two of them. One of them is Navigating Big Debt Crises, and the other one is the Changing World Order. He shows the rise and fall of superpowers. What are the different factors that rise and fall inside the nation? So looking at education, looking at military strength, looking at where the financial center of the world is, where the global reserve currency is, looks at all these factors. And there are some leading indicators, like education is one. The places with the best education in the world tend to later become superpowers. Other things are lagging indicators. So the financial center of the world and the global reserve currency are two of the last things that stick around when everything else has faded. And so whenever I hear people ask the question, well, what's going to replace the dollar? There's just no alternative. If that's your argument, then none of the fundamentals that supported it, that got the currency there in the first place, are there anymore. Your only argument is there's not yet a contender, and the key emphasis there is on yet. And so there's a lot of momentum behind the dollar. I think the biggest thing that will keep the dollar around much longer than people expect is the amount of dollar-denominated debt there is around the world. But one policy mistake of too rapid inflation for too long can wipe away the value of that dollar and cause a reset, and a new currency will take its place, regardless of what it is. It's just you make your currency less. Exactly. It happened in Germany. So you make your currency less attractive and something else will replace it. It doesn't matter whether yours used to be better or not.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club is for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
It's interesting. That was some really good points. And folks, I know some of the stuff, that you're hearing, you're like, it doesn't apply. It does apply. And all you need to do is just go back to history class and what happened with Germany. Because like literally that right there is really what we're staring down the barrel of. I mean, I think they're getting the handle on it by taking drastic action, and it's coming at the expense of every American citizen. But I also think one thing that Americans can't quite comprehend, and I totally understand it, is we do live in the greatest country on earth. I mean, we have the most freedoms. We have the biggest opportunities. So when you're thinking about other countries being attractive, like China, I mean, right now, there's not a single American, at least I think there's some that should, but there's probably not many that would be like, I'd rather live in China. But if you lived in other emerging countries where the country like Africa, for example, China probably looks like a really good place to live with opportunities and development and everything else. So sometimes the grass isn't greener on the other side simply because you have the best grass on your side. And if you flip that and you lived in another emerging country, China might look really attractive. So I think that's an interesting thing that I guess I never really thought of. But let's go to the next step and let's push the pedal down a little bit. I think a lot of people right now have a lot of fear. Rightfully so. I mean, we've gone through some interesting times politically. We've gone through some interesting times with the pandemic. And we've also been brought to a point where we really don't know what to trust. We don't know if we can trust the news. We don't know if we can trust politicians. And I completely agree. So there's a lot of distrust right now, but there's also a lot of people that feel we are going into a recession. I mean, the inverted yield curve's never been wrong. And I haven't studied this yet. Maybe this. I think this is the deepest we've ever been inverted. Maybe that's fact. Maybe it's not. But the inverted yield curve has never, ever, ever since I think since World War II, if I'm not mistaken, ever not led to a recession. But if you talk to the politicians, they say we're not going to a recession. If you talk to the Fed or you listen to the Fed, this is going to be a soft landing. Like, what do people have to do to believe things are going to be okay? Or do you just think right now it's hunker the hatchet, bunker down, get the hatches tightened up, get the family affairs in order, because we're going deep into a recession, if not the next Great Depression, as some would say? Where do you think we go? I mean, because honestly, I can't believe the markets have been as resilient as they have, but I think this is like a hangover from a really heavy night of drinking. I mean, when the Fed printed all that money, I mean, that money's still in the system, even though they're pulling it out, it's still there and it's hanging in there. And gosh, sometimes I'm just like, when is this going to drop? What are your thoughts moving forward? Let's just go. We went back, but let's go forward 3 years from where we're at now in terms of all the signs and the economic conditions that are happening. Where do you think we're going next?
Yeah. Great questions and great points. One point of clarification on the yield curve: there's never been a recession that hasn't been preceded by a yield curve inversion, but there have been 2 yield curve inversions that were not followed by a recession. And so every time there's been a recession, you say, okay, looking back, yeah, the yield curve inverted. But there have been a couple times when the yield curve inverted and then nothing. No recession took place after that.
One was not that long ago, if I'm not mistaken. I'm not getting the years right, but within the last decade that happened.
It could be. I don't know the dates on them. But yeah. So that being said, I think the steepness of the yield curve and the reasons why it's inverted are a big reason to think that, hey, yeah, we do have a recession coming up. When you take a look at the money supply, like we were talking about earlier, the Federal Reserve has been shrinking the amount of money that's in circulation. It's certainly nowhere near where it used to be prior to 2020. That's certain. But we have so much more debt than we used to. And so when you take a look at, a lot of people say in order to bring down inflation, you have to get positive real interest rates. And we haven't had positive real interest rates for a long time. We do now, but they weren't for, forever. And so they take a look at, okay, if the inflation rate is 5%, but interest rates are at 4%, then interest rates are still negative from a real standpoint. Now they're finally positive again. So inflation is 3%, interest rates are 5%. So we've got like 2% interest rates real. And a lot of people are saying that's nowhere near high enough in order to combat all the craziness from the last, 2 years, from the last decade. The problem is when you look at the amount of debt. So imagine you have $10,000 worth of debt and you make $150,000 a year. It really doesn't matter what the interest rate is on that debt. You're going to be able to pay that off. If the interest rate is 5%, you're fine. If the interest rate is 20%, you're fine. It'd be hard for interest rates to get to a point on $10,000 worth of debt if you're making 150 for that to be an issue for you. And that's where the country used to be, both individuals, corporations, the governments, both city, state, and federal. That's where things used to be. The debt used to be a lot lower than the income. But over the past, really, it's been about 10 years now of very low interest rates. And then in 2020, zero interest rates with all the money printing. It allowed the system to lever up like it never has been before. So the United States government hit 120% debt to GDP ratio. That's banana republic levels. That doesn't happen. The only time that's happened in U.S. history is during World War II, and you could just stop the spending when the war ends. And so, yes, that mattered, and that was harmful to a lot of Americans. But the spending could stop after, when the war ended. We're not fighting a war right now. It's all mandatory spending, discretionary spending, Social Security, things that it's political suicide to end any of that spending. And so when you look at the debt level and realize all of that debt was borrowed at zero interest rates, individuals too, corporations also, governments, all of that was borrowed at rock bottom interest rates. Well, when you move from 2% to 4% interest rates, that doubles your debt service cost. And if you were already maxed out and you could barely make your debt payments at 2%, 4%, you're bankrupt. It doesn't matter whether that's below the rate of inflation or not. That's going to be some extreme pain. And so because of the leverage that has built up in the system at rock bottom interest rates, and now interest rates are way higher than they were 2 years ago, that is the pain that's starting to set in. We're going to see some deleveraging. Now, it's possible that we get an inflationary deleveraging, meaning the Federal Reserve comes in at the point of maximum pain, lowers interest rates, prints a bunch of money, bails out the government. We get an inflationary deleveraging where the value of the dollar plummets, wipes out the value of the debt, the lenders get screwed, and the borrowers make out clean. And we start over from a position of way higher prices. It's very painful. You have a lot of scarcity because deleveraging is always associated with scarcity because you've already spent that purchasing power from the future in the past. That's what leverage is. And so there's still economic pain. It's just done through prices going up rather than prices going down. Right now, at least for the short term, we're doing the opposite. We're looking at a cliff of deflationary deleveraging, meaning interest rates going up. That means less spending across the board. That means some debts will get defaulted on. That means we have less money going around. And so you still, again, have scarcity. Ever since the Great Depression, we've had inflationary deleveraging. That was a deflationary deleveraging. And so you can think of that as an example of what I mean by this. But prices collapse. Again, it's just hard to get the things that you need. Either way, though, we are going to experience a deleveraging. And I think that will probably happen over the next couple of years. That's what we're looking at. We're looking at a recession really soon here. We're looking at prices going down pretty soon here. And the only one that I would anticipate to get a bailout would be the federal government. If push comes to shove, the federal government cannot borrow enough to pay off the debt that it owes and pay its bills, that's when I think the Federal Reserve will step in and copy Japan, do yield curve control, bail out the government, but everybody else has really high interest rates. Now, I want to make one note because this sounds like doom and gloom. And I always need to emphasize that recessions are the cure for the malinvestment. They're called corrections for a reason. It gets us back to where we're supposed to be. It burns off the dead wood. It forces people back to the incentives of saving, preparing, being wise with their finances, not overextending themselves. And so it is painful, but it's healthy for the system to be able to experience this. Number one. Number two, for anybody who is prepared, that's just opportunity. How nice would it have been? I see a lot of people comment, like I see videos pop up, kids that are, 21 years old, saying, man, like my biggest financial mistake was not buying a bunch of real estate in 2010 when I was in preschool. It's like, like everybody looks at that and says, okay, that was obviously in retrospect a great time to buy assets because they were on sale. That's what recessions do. So for the prepared, it allows you to get things at discount prices. And so this represents opportunity. And then the final thing is that looking really optimistically, sometimes deleveragings are not accompanied by pain because you deleverage through an increase in productive output. And so this was like after World War II, we deleveraged without experiencing a lot of pain because we basically doubled the workforce. And so we had, because of women going to work and then men coming home to work, we had a massive increase in productive output. So that offset the economic pain. We don't have that ability. We don't have people we can call home from war now. I mean, we do, but not to the same extent. Women are already all working. And so you look at a couple developments that I'm bullish on right now. A resurgence in nuclear fission energy, the potential for nuclear fusion, AI, and this is brand new, but the new room temperature ambient pressure superconductor that could be real. Any of those four things really take off, we could see a massive increase in productive output and wealth increase that could offset the pain of a deleveraging. So those are like, if any of those turn out, that could be a way that we see no pain in the next 10, 20 years.
Oh, I love that. And it's so congruent with so much of what people need to hear, because it is doom and gloom when you look at it on one side, but for those that are prepared, this could be the greatest opportunity of your life. You just got to see it. But the problem is society will fight you against that opportunity. They will fight you because today, look around, there's a lot of people playing rich. There's a lot of people out there, always spending every dollar they make so that they can look, keeping up with the Joneses, they used to call it, but I don't know what they call it now, just playing rich. Those folks are going to suffer during this next cycle. But for those of you, and it is most of you watching this episode and watching this podcast, you are ready. You are prepared. Matter of fact, some of you are just like, get this show started. It's like sitting down to watch a movie. The movie's supposed to start at 3. It starts at 3:30 because there's so many darn commercials. You're just like, can we just get this show started? We're in commercial time right now, folks. That's all this is. You are just sitting there watching the commercials. The show is going to start. It's going to be a good movie, but you got to just wait for it. And anybody that's in a rush, I think, stands to lose right now. And anybody that's in a hurry that jumps too soon when this does start to happen, you got in too early and you're going to have a hard time maintaining, which is why we didn't really talk about it too much on this. But, if you really look at treasury bonds and you look at where they're at price wise and where they're going to be in the future based on everything Joe just said, that right there, all in of itself, could be one of the greatest opportunities of most of your lifetime. And the best part about that is that's a risk-free return because U.S. Treasury bonds are guaranteed by the full faith and credit of the United States government. You just have to believe the United States of America is still the greatest country in the world and is going to be here. And, I have too many friends and family that fought for this great freedom and many that died for this great freedom that we have. So I fail to even remotely accept the fact that we don't live in the greatest country on earth. I truly do. And Joe, I can't get enough of what you're saying because it's spot on. And it's, as you were saying that, you got to it at the end, but I'm thinking that movie Dumb and Dumber. I'm just like, so you're saying there's a chance? You guys all remember that? Like, there's a strong probability, folks, things are going to get a little bumpy and a little rough, and it could be really rough. But if you just start getting ready now, you will be happy when this happens because it's just like a rollback at Walmart. Everything's going to be on sale. Yes, those real estate deals that you've been looking at, they're going to be on sale. Those cars that you've been looking at, but they're just a little too expensive, they're going to go on sale. The stock that you keep saying, oh, one of these days I'm going to own that, it's going to be really on sale. The only thing that's not going to be on sale are treasury bonds, because today is rollback day. So folks, just pay attention to what Joe's saying. And Joe, how do people find you? Where do they watch more of your stuff? How do they just get to know more about you?
Yeah. Great question. Thank you. I want to, real quick, I have a quote from Thomas Babington Macaulay. He said, on what principle is it that with nothing but improvement behind us, we are to expect nothing but deterioration before us? And it always, the apocalypse is always here. It always seems like, there's pain ahead. And the reality is, there is pain ahead. There always is. There always will be. There's always going to be suffering. Sometimes it's greater. Sometimes it's more concentrated. But in the end, we all die, right? So the suffering will always be with us. And so the answer is to prepare for it as best as possible and navigate it by learning how it works. And so that's what my main thing that I do is I try and educate people about how the financial system works, because the more I understand how it works, the better I can navigate it. It's like the more you understand how the wind works and the waves work, the better you can operate your sailboat. And so so that's what I do mainly through my YouTube channel, Heresy Financial. I also am pretty active on Twitter at Heresy Financial. And for anybody who wants really deep dives, I run Heresy Financial University. It's a membership program that gives you access. It's like Netflix for financial literacy. So deep dives on everything, teaching you how money works and how to make more with taking on less risk.
Love it. Well, folks, I don't know about you, but I'm going to be all over that YouTube channel. And I think some of you need to get into that university to learn a little bit more about this, because this could be the last stop of this train, and you better understand what you're getting off and how to manage this next awesome opportunity. Notice how I said that, not this next downturn. I said this next awesome opportunity that we're about to face. So get around Joe's campfire, check his YouTube out, check everything he's doing. If he's charging for a membership into his university, pay it, because it will be the cheapest thing you ever did that saves your ass. Excuse my language, but that's where we're at. It's an ass saving kind of time. And I think that's what you all need to do is get around it, pay attention. One final thing that I want to do, and this is a selfless plug. I just created what will be my most controversial YouTube video I've ever done. I don't know the actual title. It just came out yesterday. It's not on YouTube yet, but it's I think going to be titled 2025. I did a broadcast like it was 2025, talking about all the things that are happening then and all the signs and the things that we were warning about today. Watch that YouTube video before YouTube takes it down, because I promise you they will. But it's going to be interesting in 2025 to go back and watch that video and see how right it was, because if you just follow the signs, you can pretty much see where we're going. Joe, this has really been awesome. I appreciate you coming on the show today. You're just a wealth of knowledge in all the right areas. And I hope my audience makes the trek over to your channel and spends a lot of time there and a lot of money working with you so that they can get on the right track. Thank you again.
Thanks for having me.
All right, folks, check us out the next episode. But until then, we'll see you soon.